Helen, there is a massive difference between what the bank says you can borrow and what you can actually afford to live. How do we find that real number so a family doesn't end up house poor after buying?
Yeah, so when you're looking at affordability versus what you can actually get, we're looking at different things. We're looking at different numbers. You want to be able to afford your mortgage. Just because you can qualify for a lot doesn't mean you should be buying it. It's hard to say because it's a competitive market. And so most people right now are paying more for rent than they are for a mortgage. Right now, we're in a market where buying a home is very similar cost, but people don't actually look at different costs outside of the mortgage. So home insurance, heating, water bill, other maintenance on the home, different expenses. So when you qualify for a mortgage, I want to go over what we look at when you actually qualify and things that we consider because there's a lot of misconception for that. And I'm speaking from a mortgage broker perspective because the applications are different at a bank, and the applications that you do online on a banking app, they're not accurate. So you need to go sit down with a professional and get your documents in order to get a real pre-approval, real qualification, real numbers. Because if you fill something out on an app or it takes you 5 minutes to do, it's not a true pre-approval, right? A true pre-approval to see how much mortgage you can afford and what you should be affording. What we look at is your gross household income. So let's say we have a husband and a wife, and maybe they have two kids, and both husband and wife are salaried, and we use their gross salary. That means before taxes are deducted. And then let's say the wife also has two children and she received child benefits from Canada. That's income. We add that to her income, right? So that helps the application in terms of how much they make. And then we take their gross household income and we divide into 12 months and we see what they make gross per month. Then we look at their debts. So we go down and we look at how much debt do these people carry. If they have high debt, so maybe they have 100 grand worth of debt, but their monthly payments are low, that's ideal for us because we only look at the monthly breakdown. We don't look at how much debt you owe. You could owe 100 grand worth of debt, but have very small payments. You could owe 100 grand worth of debt and have really high payments. I've seen people with $20,000 car loans with $900 a month payment, and they're upset because they're like, well, I only have $20,000 worth of debt. Yes, but if your gross household income is $3,000 a month and your monthly car payments are $900 a month, you're not left with a lot of money left over for a mortgage and for other expenses. And then we calculate your assets as well. We want to see how much money you have saved up. What are your other assets? Are you going to be in the negative for assets after you buy the house? Most people are at zero assets when they purchase a house because they save all their savings towards the down payment, the land transfer tax, the closing costs. So most people's assets are maybe like their vehicle, some household goods, maybe like a work RSP account or something like that. As a newcomer to Canada, you don't have that luxury of having work RSPs unless you've been working for a long time, but then you're not really considered a newcomer, right? You're fresh at your job, you're just starting out, you brought all of your life savings here, you're saving every penny so you could afford a house for your family. And most people used all of their savings to buy this house because they understand that a house is the first asset they want to purchase, and then everything else is secondary, right? A vehicle, any other thing that they want to do, any money that they want to spend on vacations, they will wait until they save up for a house and buy the house first to do that. So we look at their assets and we want to make sure that their assets are not too negative afterwards. So for example, if you have more debt versus assets and you're using all of your savings towards the purchase of the home, and then you have a ton of debt after you purchase a home, that doesn't necessarily look good on your application. So we want to talk about mitigating that in the meeting, right? We want to talk about, okay, how do we make this work? How do we fix this? How do we reduce the debt? How much down payment should we use? Maybe you have money to pay out your debt first before we buy a house. You might have $50,000 saved up to buy a house, but if you have $100,000 worth of debt and they're high interest loan debt, I might say pay out all of your debts, and then we can either apply for a down payment assistance program, or we could save up a little bit more money, because you might only qualify for $100,000 or $500,000 house or $600,000 purchase price, and then you don't need as much money as you were saving up in the first place. You're better off paying out debt and clearing that, and we determine that by having a meeting. Like I said, if you do a 5-minute application on an app or a website, you don't get into the actual meat of what is going on your financial situation. So we want to break that down. So we look at your, again, monthly gross income, monthly gross debt. So we take all the debt and we look at what your monthly payments are. And the way that we calculate your debt is not necessarily the same as what you're repaying. So if you have credit card debt, we have to calculate the repayment at 3% of what you own. You might be paying less than that, or you might not be paying anything. You might be paying $10 a month, which is a minimum payment. We're not allowed to use that. Every bank and mortgage broker has to use the 3% on a credit card of repayment automatically. If you have student loans and you're not in repayments, that doesn't mean you have no debt. It means that we have to calculate the repayment, and we have to start it at 1.5%. If you have car loans, we use whatever the car loan payments are. If you have debt that is at 0% interest rate, or it's not due yet because you have deferred payments, we have to include that, because you are going to be paying that at some point. So people come to me and they're like, well, I have no debt. And then I look at their application and I see, okay, you have a lot of debt. but it's not due yet. I'm not paying this off yet. Yes, but you will have to eventually. Your mortgage is going to last for 20 years or 25 years. Your debt is going to commence in a year. It doesn't mean you have no debt. We have to calculate that in. So that is a very common misconception that people have. I would say when you're buying a house, again, try to save up as much money as possible. Don't buy any vehicles. Don't have any high debts, because you really just want to save your money for that. Don't buy furniture ahead of time. I've seen that too. People buying furniture and appliances before they own a house. And I'm like, okay, why did you just spend $10,000 before you bought a house on debt? And they're like, oh, I wanted to buy appliances. I wanted to buy new furniture. You don't even have the house yet. So, wait until you own the house to do that. So
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
we look at all these aspects of how you spend money, how much money you make, and then we have what's called the stress test as well. So we look at today's interest rates, and we look at how much you can afford based on your income and your down payment and your debt. So it's your income minus your down payment, or sorry, it's your income minus your debt plus your down payment. We do incorporate heating costs into your debt, because you do have to heat a house. And what we use on an application versus what your actual heating costs are going to be very different. Because normally I can use $100 to calculate your heating cost on a house, or $50 on a condo. That's not what your actual heating costs are going to be. I do have to include your property taxes. I calculate your property taxes as they are of the year that you're purchasing the house. So you could be buying a house where the property taxes right now are $3,000. But if you're buying a house for $500,000, it triggers a tax implication for next year through the municipality. And so your taxes vary by municipalities. They're not always calculated the same, but let's, for the sake of numbers, say it's going to be around 1% of the purchase price. So next year, your taxes are going to go up to $5,000 a month, because you just bought a house for $500,000. So when I do an affordability calculator versus what you can actually afford, those are the numbers that we talk about, because you have to be able to afford it. And most people come in and say, well, my rent is $3,000 a month, but that's everything included, right? You're not including other aspects of property taxes, actual heating for a house that you own. If you're buying an older home or if you're buying a mobile home, your heating is going to be quite a bit higher. You might need some renovations right away, or you might need home renovations. You need home insurance. If you're a new homeowner and the house is old, your home insurance is going to be higher. So there's a lot of those things that we look at together. And I could say, yes, based on this mortgage application, you can afford a house for $500,000. Here are the real numbers of what this is going to look like next year when you buy this house and you own this house, and these are your minimum costs. We look at the heating bill for the sellers if they have it, which is a really good indicator of how much you're going to be paying in heat, because a lot of the times if it's an older home, which there are a lot of in Nova Scotia, your heating bill is going to be really, really high. And you would have to consider that because everybody has different heating. Some people keep their heat on 19 degrees in the house. Some people keep it on 25. That's going to make a huge difference in your bill. There are ways to pay that off. So we have monthly repayment plans. Same with the property taxes. You don't have to stress so much, but you can break down that debt into monthly plans. But again, it's going to add up, right? It's not just $3,000 in mortgage payments or rent. You have your taxes, that's another couple $100 a month. You have your heating, that's another couple $100 a month. You have your insurance, that's another couple of $1,000 a month. So you're looking at it and you're at $4,000, right? That's a big difference. And so that is the difference between what you can afford and what you're actually going to be making payments on, and whether you can afford to make that change and you can afford those payments.
And I think that sometimes the people used to make that mistake that they see the approval for 500,000 and they say I can buy it, but at the end of the day they cannot, because they can only afford probably a 300,000 house,
Yeah.
not a 500, because they cannot pay it ahead, as you say.
The unfortunate thing in our industry is that people want to push out a mortgage to a person, whether you're at a bank or a broker. A lot of the times we just push out like, this is what you're afford, this is what your maximum amount is that you can afford based on the numbers that we ran, because we want you to buy a house and actually be able to buy a house. Because the other problem right now is that if you're qualified for under $500,000, you're not going to be buying a house, or you're going to be buying something very small or fixer up or something that's outside of the Halifax, main area, outside of HRM. And there's still a lot of people bidding and outbidding on the, base price that you see on the sale price. They outbid that price because they want to buy a house for, I don't know, if they're pre-approved for up to 500, they'll go and look at a house that's 450 and they'll bid 500. And anybody else who could only afford 450 is getting outbid now. So this is the situation here. If you could afford a house for over 600,000, which is not a lot of people, right? Because how we qualify the rule of thumb is if you have zero debt, it's your gross household income times 4 is what you can afford for a purchase price or a mortgage, plus your down payment, right? So if you're only making if your household income is making $100,000 a year, which seems like a lot in Nova Scotia, right? Because what is the average income right now in Nova Scotia? I want to say it's around 50K, right? If your average income, yours is 50K and your spouse is 50K and you're making $100K a year together, you think you're going to afford a lot because you're paying a lot in rent and you're paying a lot in bills. But realistically, you're only looking at $400,000, not including debt. That's assuming you have zero debt. If you have debt, that number gets reduced significantly. And then people are like, oh my gosh, how do I afford this? Well, that is when you talk to a mortgage broker and we look at different plans and how to get you there. Because I am a strong believer in buying a house versus renting, of course, because you are building assets, you are building equity. I am also a strong believer of sacrificing comfort for future comfort and future growth and future wealth. So my husband and I, when we bought our first house years ago, we were not in the best financial situation because we had a house that we couldn't sell in a different province, and we were trying to buy a house here. So our affordability was just not working out. And so we bought a cheap house. It was a fixer-upper. It had a leaky roof. It didn't have heating. We somehow got a mortgage for it. And we were happy because it was our first home together, but we were also miserable because we bought it in winter. So
It was very
we,
difficult.
but we fixed it up. We fixed it up ourselves. Whatever we had to pay for, we saved up and paid for, but everything else we fixed up ourselves, and we sold that home for profit, and we kind of got into house flipping with that. So that is, in my mind, that is a good way to build wealth in Canada, because you're sacrificing something now to build an asset, to build your equity, and then you can resell it once you put your what we call sweat equity into it. So when you work on the house, you fix it up yourself. You're not really going to get that same money back if you buy a car, if you spend that time on something else. A house is really one of the only things that you can grow wealth in if you put your own money and time into it. Um, it's really hard to do with anything else in Canada in comparison.
Thank you so much, Helen. This information is very helpful for us, and I think that people should contact you in order to go deep in this information and to have a correct assessment where they can find you.
You could look me up on Gonda Mortgages or Helen at gettheidealmortgage.com. You can also reach me by phone or contact me through the video, and we'll reach out to you.
Once you have your budget, you need a cash. Do you really need 20% down? Click here to discover the minimum requirements to buy a house in Canada today.